Let's talk about something boring but crucial: accounting standards. Specifically, IFRS 15, revenue from contracts with customers. Before this, companies used a mess of conflicting rules to recognize revenue. It was financial chaos. IFRS 15 changed the game by creating a single, global framework for revenue recognition. Now companies must answer, when did you actually earn this money? The answer isn't always obvious. The goal? Transparency and comparability. So when a company claims $1 billion in revenue, it actually earned it. Let's break down the 5-step model that's reshaped how businesses report revenue. IFRS 15 is built on a 5-step model. It's not glamorous, but it keeps companies honest. Step 1. Identify the contract. Is there a real, enforceable deal? Step 2. Identify performance obligations. What exactly did you promise? Step 3. Determine the transaction price. How much are you getting? Step 4. Allocate the price to each promise. Step 5. Recognize revenue when you deliver on each promise. It's about earning revenue, not just receiving cash. This model forces companies to match revenue to real performance, not wishful thinking. Step 1. Identify the contract. Before you can recognize any revenue, you need to be absolutely sure there's a real binding agreement in place. This means both parties have agreed to the terms, and there's a clear understanding of what's expected from each side. It's not a contract unless both sides approve, terms are clear, and payment is probable. If there's any doubt about whether someone will pay, or if the agreement is vague, it doesn't count as a contract for accounting purposes. Example: a gym membership with a signed agreement and valid payment info? That's a contract. The gym promises access to facilities, and you promise to pay. Both sides know what's expected. A free trial? Not until you commit to pay. If you can walk away without paying, there's no contract yet. Step 2. Identify performance obligations. What did you actually promise to deliver? Every contract is made up of promises. These are called performance obligations. You need to break down exactly what you owe the customer. In a phone bundle, the phone, a streaming service, and software updates are all separate obligations. Each one is a distinct promise, and you have to account for them individually. Each must be distinct, something the customer can use on its own or with other resources. If a customer can benefit from a product or service by itself, or with things they already have, it's a separate obligation. Old rules let companies lump everything together. That made it hard to see what was really being delivered, and when. IFRS 15 says, unbundle and recognize revenue as you deliver each part. This means you can't just recognize all the revenue up front. This stops companies from pulling future earnings into today's numbers. It keeps financial statements more accurate and transparent. It's about clarity, what's promised and when it's delivered. Investors and customers can see exactly what's happening and when. That's how you keep revenue honest and ensure everyone knows what to expect from the contract. Step 3. Determine the transaction price. This is where things get interesting. It's not just about slapping a price tag on your product or service and calling it a day. You need to dig deeper and consider all the factors that could affect what you'll actually receive. It's not always the sticker price. You must factor in discounts, bonuses, and returns. Maybe you offer a seasonal promotion, or customers can earn loyalty rewards. Sometimes products are returned or services aren't fully used. All of these impact the final amount you'll collect. So you estimate what you'll actually collect, not just what's on paper. This means looking at your history, predicting customer behavior, and being realistic about what will end up in your bank account. Step 4. Allocate the price to each performance obligation based on standalone value. This step is crucial when you're selling bundles or packages with multiple promises. For example, imagine a $1,200 phone bundle. If the phone alone is $1,000, streaming is $120, and updates are $180, you can't just lump it all together. You allocate the $1,200 proportionally, spreading the total price across each part of the bundle based on its individual value. This ensures each component gets its fair share. Each promise gets a fair share of the total price, reflecting what customers are really paying for each part. You can't just say the phone is worth the whole amount and the rest is free. That wouldn't be fair or accurate, and it wouldn't give a true picture of your business. This process forces companies to value every promise realistically, making sure nothing is overlooked or undervalued. It's about honest, transparent reporting. Investors, regulators, and customers all benefit from knowing exactly what's being paid for. No more hiding the real value of bundled deals. Every part of the transaction is visible and justified. Every dollar is accounted for, and every promise is recognized. That's how you build trust and keep your financial house in order. Step 5. Recognize revenue when you deliver on your promise. This is the moment when all your hard work, planning, and negotiation finally translate into financial results on your books. But, as you'll see, it's not always as simple as just getting paid. For goods, that's usually when the customer takes control, when they receive the product and can use it as they wish. It's the point where ownership and risks transfer from the seller to the buyer. For services, it's a bit different. Revenue is recognized over time as the service is actually provided and the customer benefits from your expertise or support. This could mean days, weeks, or even months, depending on the contract. In our phone bundle example, revenue for the handset is recognized the moment it's handed over to the customer, since they now own the device and can use it right away. But for streaming services and software updates included in the bundle, revenue is recognized monthly, spread out over the year as those services are delivered and enjoyed by the customer. For software subscriptions, it's the same idea. Revenue is spread evenly across the entire subscription period, reflecting the ongoing access and support provided, not just a one-time payment. Construction companies recognize revenue as work progresses, not just at completion. This means they track milestones and bill for work as it's finished, giving a more accurate view of project progress and financial health. Concert promoters, on the other hand, only recognize ticket revenue after the show has taken place, even if tickets were sold months in advance. The event must actually happen before the revenue is counted. The key rule here is to match revenue to actual fulfillment of your promise, not just when cash is received. This ensures your financial statements reflect real business activity. This approach gives a much truer, more transparent picture of business performance, helping investors and managers make better decisions. It's a fundamental shift in timing for many industries, requiring new systems and careful tracking to get it right. That's the heart of IFRS 15, recognizing revenue when and only when you've truly delivered what you promised. Implementing IFRS 15 wasn't easy. It demanded judgment, new data, and better systems. Companies had to estimate values, track performance obligations, and upgrade their accounting software. Contract changes became a minefield. Sometimes you recalculate everything from scratch. The pain is the point. It forces companies to truly understand their contracts and revenue streams. It demands transparency and rigorous disclosure. Yes, it's a headache, but it's also a powerful tool for honest reporting. The difficulty means the standard is working. It's tough medicine, but it's making financial reporting healthier. Why should you care? Because IFRS 15 is about trust and comparability. Investors can finally compare companies on a level playing field. Revenue now reflects real performance, not accounting tricks. Companies gain better insight into what's profitable and what's not. It leads to smarter decisions and more disciplined management. The standard brings clarity to the most important number on the financial statement. It's complex, but it's a leap forward for transparency. Now, we made $1 billion actually means something. Understanding IFRS 15 isn't just for accountants, it's for anyone who wants to know how business really works. Boring? Maybe. But it's making the financial world a lot more honest.